Right friends, welcome back once again to Learning Space. Today informally we are going to discuss some questions and answers, how to answer various banking questions, and let me once again reiterate to you whatever we presented in YouTube channel, these banking lectures as well as all these modules are very important because they are made in highly scientific way. Please view all those capsules as I have already told you previously, and at the same time in recent times I selected 16 capsules from current affairs, starting from this one China policy, financial stability report, digital, then monetary policy towards digital, like that. And these 16 capsules please view once again, because I selected these 16 capsules during the past 2-3 months and view all of them. And subsequently today discussion basically question and answer format, and what are the steps to be taken while attending interviews, all those aspects we will see next week. Today my main concentration is how to answer various questions, what type of questions are expected, and today I am not considering the questions pertaining to recent ones, especially demonetization, and some people are asking about blockchain technology, at the same time Bitcoin, all these things we will discuss next week. And here today questions, please let us start, and I have chosen these 16 questions for today, and I have taken the suggestions from various students, and please send your doubts, whatever doubt you have, banking@learningspace.in, banking@learningspace.in, please send your queries, we will discuss next week. Whatever time it takes, it does not matter, I would like to clarify all your doubts, so that in the process you will have lot of insight into recent events. Right, look at the first question. What do you understand by fund of funds? You can expect this type of question. Why banks are not able to finance startup firms? And here startup firms, this is the buzzword nowadays. What is the meaning of a startup firm? Startup firm is the firm which is established just now. That means during the past 1 year or 2 years, the firm which was established with minimum capital, and that firm is startup firm. And startup firms, it is normally that easy to get loan from banks, because of the reason startup firms may not be able to give collateral security. That is the main problem. These startup firms, just like MSMEs, may not be able to give collateral security. That is one problem. Second problem with the startup firms is, startup firms, whether they have got growth potential or not in future, whether they are going to become bigger firms or not, that is very difficult to judge for the banks. And banks normally go with the system of collecting interest and EMIs, but startup firms funding is something different, and that is why, because of these 2-3 reasons. One is, this question is normally expected, why banks are not able to finance startup firms? First thing is collateral security, second point is growth prospects of the firm are not established, so that is, so it is not that easy. So next point is, startup firms normally expect, startup firms normally expect funding in the form of angel investment or venture capital. These 2 words are buzzwords, so please understand clearly, angel investment, venture capital, these are intended for startup firms, not banking system. Banking system feels that financing startups is risky venture, because normally in startups 2-3% or at the most 5-10% will be successful, remaining 90% will fail. But if 1%, 2% are successful, they will become huge success. This charging interest, giving loans, this process will not work for startup firms. So, that is why startup firms financing is not that easy for the banks. That is why they require different types of funding. What are those different types of funding? They are called angel investment as well as venture capital. So, angel investment, venture capital, these are the funds meant for startup firms. So, angel investment is small, maybe 5 lakhs, 10 lakhs, 15 lakhs, 20 lakhs, and normally it is given from well-wishers and relatives. This angel investment is the investment at the initial stage of the firm and normally given by relatives or friends or well-wishers. That is not much, 5 lakhs, 10 lakhs, 20 lakhs, something like that. Then second one is venture capital. Venture capital is little bit more in comparison to angel investment. Angel investment is not that significant, but venture capital is quite significant, maybe 5 crores, 10 crores, 20 crores, something like that. So, angel investment, venture capital, these are the funding mechanisms for startup firms. Banks, I have told you, they are not in a position to fund them, right. So, the second question is answered, why banks are not able to finance startups. Let us come back to the first question. What do you understand by fund of funds? Now, recently, that means last year, government has given rupees 10,000 crore fund of funds, rupees 10,000 crore fund of funds, and this will be maintained by SIDBI. Here how the mechanism works, please look into this. SIDBI will maintain rupees 10,000 crore fund of funds, and this will be invested in some alternate investment fund. Here it will not directly invest in some startup. Please understand this carefully. In between there is some alternate investment fund. What is alternate investment fund? That is either angel investment or venture capital or private equity. Let us leave private equity because private equity is somewhat grown up firms, not for startup firms. So, for startup firms, angel investments as well as venture capital. So, here this fund of funds that is maintained by SIDBI and that will be invested in some intermediary venture capital fund. It will not directly invest in startups. So, this is fund of funds. Fund of funds meaning is this is invested in some intermediary venture capital fund, and in turn that intermediary venture capital fund will invest in startups. So, this is the meaning of fund of funds. So, here two questions are answered. One is what is the meaning of fund of funds and why banks are not able to finance startup firms because of risk element involved. I hope that you are clear about it. Fund of funds, normally they invest in some intermediary and subsequently they will invest in startups. This way the risk is minimized and this intermediary will have better knowledge about which startup will grow, which startup will flourish in future, right. So, this is just like you can say mutual funds. Mutual funds also you and I invest and the asset management company by applying their brain they invest in various companies. We do not directly invest in shares or bonds of some company. So, that is intermediary mutual funds. Like that here fund of funds also this is intermediary. And let us look at another question. You can expect this also. What do you understand by alternate investment funds? Recently, N.R. Narayana Murthy committee was constituted to look at the funding mechanism for startups, and this is alternative investment funds. Alternative investment funds are angel investment, venture capital, private equity. These are known as alternative investment funds because of the reason the funding pattern to startups is entirely different. When startups are funded, then they will take share of it, right. So, certain part of the ownership will be assumed by either angel investor or venture capital, right. Sharia banking. this is the word recently because Reserve Bank of India recently one paper was sent to Finance Ministry so as to allow Sharia banking on experimental basis. That was not decided till date, but a proposal was mooted by Reserve Bank of India to Finance Ministry. Sharia banking, what do you understand by it? Two things are very important. When someone talks about Sharia banking, first point is, it is not conventional banking, what we follow in our country. In our country, we take money from the bank, we take loan, we pay principal as well as interest through our monthly EMIs. But Sharia banking is, here interest is totally prohibited, no interest. Interest is prohibited as per Sharia. Sharia law is taken for Quran. Please understand carefully. Sharia banking, other name is Islamic banking. So, this Sharia banking or Islamic banking, the prime tenets is basically from Quran, and Quran prohibits interest. So, that is why interest will not be involved. When banks are funding, then ultimately profits will be shared by the lender and the borrower. Profits will be shared between the lender, that is bank, as well as borrower, right. So, the basic process of this Sharia banking is interest is prohibited, profit is shared between lender and borrower, and this is as per Quran, and it is not in vogue in our country, it is in vogue in some Gulf countries or this Muslim countries, you can say. So, in India it is not in vogue, but you can expect such type of question. What do you understand by Sharia banking? What do you understand by refinancing? Quite often we come across so and so is a refinancing organization, SIDBI is a refinancing organization, Mudra Bank is refinancing organization, NABARD is refinancing organization. Like that news items you come across. So, what do you understand by refinancing? Refinancing means, let us look at some MSME or some small entrepreneur. State Bank of India is giving a loan, and up to the extent State Bank of India is giving a loan to the small entrepreneur, then Mudra Bank will arrange that much to the State Bank of India. So, normally the interest rate will also be less. Sometimes it may be less, sometimes it may not be less, but refinancing is the mechanism where bank will act as intermediary. Here bank is giving a loan to some MSME, but that is refinanced by some organization. In this case, Mudra Bank. Mudra Bank is giving to State Bank of India, in turn State Bank of India is giving to some small MSME. So, Mudra Bank is not giving directly to MSME, it will not give directly. So, here the loan is given through some intermediary, this is refinancing. So, whatever I told, that is fund of funds or refinancing, these are very, very important words, please do not forget. So, there are several refinancing organizations, SIDBI, Mudra Bank, NABARD, NHB. So, these are all you can say refinancing organizations basically to promote something. NABARD is basically to promote agriculture sector, Mudra Bank is basically to promote MSME sector. So, like that, right. So, let us look at the next question. We often hear about foreign portfolio investments as well as foreign direct investments. Some question is expected, what do you understand by FPI? What do you understand by FDI? What is the difference between FPI and FDI? In the coming lectures next week, we will discuss about trade deficit, current account deficit, balance of payments, those things we will discuss next week, and today our discussion will be limited to what is the meaning of foreign portfolio investments, foreign direct investments. let us look at foreign portfolio investments. Foreign portfolio investments means from western countries, you can say the countries where interest rates are less. Please understand carefully, these are developed countries like European Union countries or America, Canada, so Australia, these type of countries, right, their interest rates are normally less. Interest rate there is 1%, 2%, something like that. But in our country, the returns are quite substantial. If you invest in government bond itself, the interest rate here is 6%, 7%. And here, if somebody is investing in shares, share market, leave the short term volatility, I am not talking about short term. If you are investing for 1 year or 2 years, definitely you will get 8%, 10% return. So, in India, the returns are more. India is emerging market. I will come to what is meant by emerging market a little while later. So, here the developed countries, because their interest rates are less, returns are less, 1%, 2% interest rate is very less. That is why what they will do? They will invest in Indian stock market. They will invest in Indian stock market subject to the limits. There may be some limits, but subject to the limits, they invest in Indian stock market like Bombay Stock Exchange, National Stock Exchange. So, that is foreign portfolio investments. Foreign portfolio investments, and whoever are investing from there, they have to take approval from SEBI. With SEBI's approval, they have to invest in Indian stock exchanges, that is foreign portfolio investment, right. Why they are coming to our country? The answer is simple, expecting more returns, because here interest rates and returns expected from shares are quite high, and there lot of money is there in foreign countries, pension funds, insurance funds, they have billions of dollars. If they invest in America or Canada, their interest will be 1%, 2%. So, they come to country like India and they invest here to get 7%, 6%, 8%. But what is the risk? Risk is currency depreciation. If our currency is not stable, if currency is depreciating, today it is 68 rupees per dollar. If tomorrow it becomes rupees 100 per dollar, then they will be the losers. So, they come to the country where currency is stable. Our currency is perceived to be stable, that is why they are coming to our country, right. So, that is one part. Second part is the funds whatever are coming from foreign land, they are foreign portfolio investors. Foreign means foreign land, portfolio, they are investing in stock markets, investors, right. So, they have to take approval from Securities and Exchange Board of India, because SEBI is the capital market regulator. These type of investments comes under capital market, because they are assuming part ownership of companies. If foreign portfolio investors are investing in the stock exchange, then what indicates? What it indicates? It indicates that they are assuming part ownership. So, SEBI approval is required. Another point I would like to tell you is, as I have already told you, foreign portfolio investors, insurance funds, pension funds from foreign land, they require approval from SEBI. Other point is, they can issue participatory notes also. They can issue participatory notes, and through participatory notes, they can make investments in our country. And recently, Securities and Exchange Board of India introduced KYC for participatory notes also, because participatory notes are perceived to be conduits for black money, and so as to prevent it, this KYC was introduced for participatory notes also. So, you may get a question, who will issue participatory notes? Participatory notes are issued by foreign portfolio investors. And Why KYC is introduced for participatory notes? KYC is introduced for participatory notes because they are suspected to be conduits for black money. And here from United States of America, money is coming to our stock market, and I have given various traits of those investments, and these are known as capital flows, because they directly invest in Indian stock market. Physically they are not investing anything here, they are investing in financial instruments, just capital is flowing, that is all, right. So, it is known as hot money. Please understand, somebody may ask you what is meant by hot money. Hot money is the foreign portfolio investment is hot money because of the reason no one knows when it comes, when it goes. Then passive investment, it is not active investment. Passive means they are just investing in stock market, they are not investing in any assets here. If some Coca-Cola company is established, if some Pepsi company is established, that is active investment, that is foreign direct investment, but this is passive investment. Then highly volatile, not stable, that is why it is hot money, right. So, investments in financial assets, here I would like to put forth 2-3 points. Somebody may ask you what is hot money. Hot money is the money which comes to the places wherever returns are more. When returns expected in Indonesia is more, then money will flow to Indonesia. Immediately if returns expected in Mexico are more, then the money will flow to Mexico. So, it will just go from one place to other place, that is why it is called hot money. And some people ask you about hard currency. Hard currency means the currency which is perceived to be stable, at the same time which is normally used for international transactions. So, that is hard currency. So, United States dollar is example of hard currency. Hot money is something different, that is wherever profits are expected, that will go from here to there, then can come and go at any time. It creates asset bubbles, asset crashes. Because of this, asset bubbles are created, asset crashes are created when heavy money comes. If FPI comes too much, then artificially stock market will rise, that is asset bubble. If money goes away suddenly, then the stock market will crash, that is asset crash. Then currency appreciation, depreciations also will take place, because if heavy money flows in, then currency appreciation will be there, and if money goes away, then depreciation will be there. So, developing countries are affected. Why I am taking too much time on this is, normally if any question is asked on this, several students may not be able to answer, and some questions like hot money, hard currency, developing countries, emerging economies, foreign portfolio investments, capital flows, capital flight, these are expected in interviews. Next, foreign direct investment. We deliberated about the foreign portfolio investment which is unstable. Foreign direct investment. Foreign direct investment is investment in the assets. Multinational companies, multinational corporations, all of you are familiar with Coca-Cola, Pepsi, Nestle, Mercedes-Benz, Toyota, Hyundai. These do not belong to our country. They are from foreign country, but they established their bases here. So, they are multinational corporations. So, the investment of FDI is a stable investment. If they are coming to invest in our country, if they are coming to invest in our country, suppose let us take Pepsi, they cannot go away easily. So, this foreign direct investment is stable, long term, then it stays on for long time, not easy to exit. Then interest is to establish enterprise, car factory and PepsiCo factory, Coca-Cola factory. So, its interest is to establish something here. It creates jobs, it comes with modern technology, it aids in GDP and it invests in physical assets, right. So, These are the traits of FDI. So, you should be in a position to differentiate between what is FPI, what is FDI, and you may have a question whether FDI is good for a country or not. Whether FDI is good for a country or not. You can have answer positive aspects, negative aspects. FDI is good if you look at the jobs created, at the same time the investment, technology transfer that will create jobs, GDP will be improved. So, all these things are positive aspects. Negative aspects are because of this foreign direct investment, that means you can say because of globalization, when more and more foreign direct investment is coming to the country without any restrictions, that is nothing but globalization. So, because of more and more investments, sometimes domestic industries may be affected, right. So, this way you can answer this, and when we discuss globalization, we can discuss threadbare, what are positives, what are negatives, right. So, then next question, what will happen if excessive capital flows as well as capital flight takes place from an emerging country like India? Capital flight, capital flows. So, here before going into what is meant by capital flows, capital flight, what is meant by emerging country? Emerging country example is India, Brazil, Russia, these are all examples of emerging economies. So, the meaning is the countries with business activity in the process of rapid growth and industrialization, and two important points please do not forget, they are highly important. Second point is they have got a high potential of GDP growth. So, emerging countries, emerging economies sometimes you call, the meaning is they have high potential for GDP growth. Second thing is they are very important from the world economic perspective. Then developing countries, nowadays this developing countries norm is not there actually. Then World Bank bifurcated countries 4 types. World Bank bifurcated countries based on gross national income per capita national income. Based on that, countries are divided into low income countries, lower middle income countries, upper middle income countries, high income countries, and India is a lower middle income country. And now let us come back to the question, excessive capital inflows. We discussed about FPI, I am not talking about FDI. Capital flows means normally we talk about FPI, foreign portfolio investments. If there are excessive capital inflows, then what will happen? Artificially stock market will rise and appreciation of currencies will take place. Currency will appreciate because more and more dollars will come to the country, right. Then capital flight, this term quite frequently you come across, this is going away, money is going away from our stock market, that is capital flight, and because of capital flight asset crashes, stock market will crash and depreciation of currencies will take place, right. So, this is about capital flows, capital flight. Then next point is recently Federal Reserve. What is Federal Reserve? That is the central bank of United States of America. Recently Federal Reserve increased interest rates. All of you are familiar with some 0.25% something the interest rates were increased. And why there is a panic in emerging markets? Emerging markets like India, Mexico, Indonesia, why there is a panic in emerging markets? There is a panic in emerging markets because of the reason when they are increasing interest rates. When America or any advanced country is increasing interest rates, then what will happen? I told you in the beginning, why foreign portfolio investment is coming to our country? Because of interest difference, that is known as interest arbitrage. Somebody may ask you, what is the meaning of arbitrage? Arbitrage means difference. Interest in America is 2%, interest in India is 6%. So, there is a difference in interest, that is arbitrage, interest arbitrage. So, because of interest arbitrage, they are coming to our country. But now what is being happened? When America increases interest rates, American interest rates will increase. India interest rates are reducing. So, you see the sequence. In India, interest rates are reducing. In America, interest rates are increasing. So, the arbitrage will be less. At the same time, there will be currency risk also. So, by considering all these factors, when interest rates in advanced countries are increased, then the stock markets, from the stock markets, the money will be withdrawn, capital flight will take place. I just now told you what is meant by capital flight. This capital flight means money from our stock markets will go away, because there will be less interest arbitrage. When the returns are more in US economy, then what is the point for them to invest in our country? So, when returns are more in advanced economies, then capital flight will take place. Because of capital flight, our stock market may collapse and depreciation in currencies may take place. So, this is the fear, but nothing happened in our country, because two reasons. One is, India is anticipating this interest increase for quite some time, for the past 1 year. Second point is, the interest increase is also not much, it is hardly 0.25%, something like that. So, that is why India is not affected much, but you should be in a position to answer such type of questions. Why global oil prices are increasing in recent times? And in fact, you should have issue with regard to oil prices. You should know the theory behind oil prices. Oil prices, previously they used to be $100 per barrel. If you go back around 2.5 years, $100 per barrel, $110 per barrel. They came down to around $25 to $30 per barrel, and now they are increasing to around $50 per barrel. So, why they collapsed 2 years ago? Why they are increasing now? So, nobody will ask you why they collapsed 2 years ago. Now, why they are increasing, some people may ask you. Here, one important point is, oil prices collapsed because of 2-3 reasons 2-3 years ago. First and the foremost is shale oil extraction in United States of America. Shale oil, that is through the process of fracking, that technology was devised. That means, from shale, this oil was started extracting. That means, oil was extracted from shale, and this is through process of fracking or hydraulic fracturing, horizontal fracturing. Through the fracking process, that oil was taken out, and that is shale oil. This shale oil, America became prominent for taking out this shale oil. That is one reason. Second reason is global recession. Because of these two reasons, oil prices collapsed, and once oil prices started collapsing, then it resulted in more and more surplus, because when oil becomes a surplus, when oil in the world becomes a surplus, what the countries have to do? Countries have to reduce the output, reduce the supply. Basically, the problem during the past 1 or 2 years in the oil sector is, demand is less, supply is more. Demand is less, supply is more. So, then what will happen? Prices will collapse. Demand is less, supply is more. Because of this reason, for the past 2 years, prices collapsed, and now recently, Organization of the Petroleum Exporting Countries, OPEC countries, non-OPEC countries decided to reduce supply. OPEC countries, non-OPEC countries recently decided to reduce supply. That is why this oil prices will increase further in the near future also. Right? So, there are some other reasons, but in a nutshell, I told you some of the reasons for recent increase in oil prices. Then the next important question which you can expect is, what do you understand by MSMEs? Micro, small and medium enterprises. these are defined as per MSME Development Act of 2006, MSME Development Act of 2006, and as per that act, if the investment, based on the investment, they are differentiated as micro, small, medium, and there are two categories, one for equipment, one for services, other one is manufacturing. So, this is available in the banking awareness module. Somebody may ask you what is meant by MSME, because in recent times this credit guarantee came to focus. We will discuss as and when that question comes. Interest subvention as well as credit guarantee, these two are important terms, you should not forget. Then clearly differentiate between universal banks and differentiated banks or NIC banks. This question is expected. How do you differentiate between universal banks and NIC banks or differentiated banks? Recently, this small finance banks as well as payments banks are started operating. Airtel became the first payments bank in the country, then Capital Small Finance Bank became the first small finance bank in the country, and several other banks are also opening nowadays. So, these are known as NIC banks or differentiated banks, NIC banks or differentiated banks. And the present banking system, State Bank of India, ICICI Bank, Canara Bank, these are all known as universal banks. There is clear cut demarcation between universal banks as well as NIC banks or differentiated banks. And universal banks example, all the present existing commercial banks are universal banks, and now the new payment banks as well as small finance banks are being started. So, universal banks are basically, they can take up any type of operation. Universal banks can give loans, small loans, big corporate loans, they can do any type of activity I have listed. They can give small retail loans, corporate sector loans running into hundreds of crores of rupees, maybe thousands of crores of rupees. They can invest in capital market, they can invest in shares also. Some of you may not aware about it. They invest in money market instruments, they invest in shares, that is known as treasury banking. When you are looking at banking operations, please do not forget, banking operations basically bifurcated into three. One is retail banking, small loans to people like you and me. Second one is corporate banking or wholesale banking, that is basically giving loans to corporates like Ambani. Then third one is treasury operations. Treasury operations means cash management, and banks invest in money market instruments as well as shares, that is treasury operations. So, banks get income through these three types of operations, right. So, the next one is they participate in call money transactions, money market transactions, foreign exchange transactions, then selling insurance products for third parties and issuing non-fund based support with performance guarantee and letter of credit. We discussed what is meant by performance guarantee and letter of credit in banking, please view that. So, let us come back to this. Universal banks can do any type of operation, but NIC banks can do only specific operation, that is why they are called NIC bank or differentiated bank. In India, for the first time, these NIC banks or differentiated banks are started. So, payment banks, what they can do, what they cannot do, this is very important, please go through this slide. Payment banks, they can accept deposits up to rupees 1 lakh per individual, not more than that. And they can open both business account, current account as well as savings account. Debit card can be issued, and what they cannot do, this is very important, they cannot allow to lend, they cannot lend, and they cannot issue credit cards, they cannot accept NRI deposits, right. So, they are meant for high volume, low value transactions. So, this is the basic trait of this payment banks. So, payment banks, now Airtel started payments banks, almost 29 states they covered starting from Rajasthan. India Post is going to start payment bank shortly, and 3 have withdrawn. This 3 I have marked here. So, shortly all the remaining are going to start payments bank operations, and if you look at the small finance banks basically two important features do not forget. One is 75% of the loans to priority sector, normal universal banks 40% loans to priority sector, but here 75% of the loans to priority sector and 50% of the loan portfolio must be up to 25 lakhs size, basically to give to small and medium enterprises. So, this small finance banks loan size is less and 75% of the loans to priority sector lending, right. So, these things are very important and all of you are familiar with them. Next question, what do you understand by one China policy? Though this is not related to banking, but this question is expected because people are talking about one China policy. All of you are familiar with China and Taiwan. China and Taiwan, all of you are familiar with. This is China, this is Taiwan. And in the year 1949, here in China, nationalists lost to communists, you can say in a revolution. Then nationalists who were lost have fled to Taiwan. From here they fled to Taiwan and they started ruling from Taiwan, and communists established government in mainland China. So, till 1949 these communists are ruling China and Taiwan established its own government, that is nationalist government in 1949, and two countries are separate, but China feels that Taiwan is a part of China. Taiwan is a part of China, China feels so, and China also states that whoever keeps diplomatic relations with Taiwan, whoever maintains diplomatic relations with Taiwan cannot have diplomatic relations with China. So, if anyone wants to have diplomatic relations with China, they cannot have official relations with Taiwan. So, this is one China policy. Very few countries recognize Taiwan as independent country. So, because of China's rule, if anyone has got any official relationship with Taiwan, they cannot have diplomatic relations with mainland China. So, this is about one China policy. So, with this today's lecture, let us conclude. We could deliberate 10 questions because of time, and at 9 o'clock we have Hindi lecture, and we are going to continue next week from Monday onwards. So, we will discuss remaining questions from Monday onwards, and I hope that you benefited from this discussion. Today I discussed somewhat economy related issues, because sometimes in examinations these are also asked. You should have clear idea about all these things, and at the same time please view once again, and the modules which I have stated, please view all those capsules, you will have clear idea about banking. So, with this we are concluding today's interview session, first session. Second session we will announce, and we will have probably on Monday, and whoever not able to follow English session, जो इंग्लिश में नहीं फॉलो करता है वो 9 बजे जो हिंदी में स्टार्ट होने वाला लेक्चर है उसमें ज्वाइन कर लीजिए. So, with this, have a good night, and let us conclude today's interview session. Good night.